We are back at it. Let's get into these bookkeeping problems. We've got those day book totals to find and some ledger entries to sort out. Do you want to take this step by step from the top, or is there a specific spot where you want to jump in? All right, let's tackle the sales day book first. The sales day book is specifically for sales made on credit. If someone pays cash right away, it goes in the cash book instead. So, we're scanning your notes for credit sales only. First one I see is on May 1st. We sold $160 of goods to P. Dixon on credit. That 160 comes straight from the first transaction in your notes. Now, May 4th is a bit tricky. We sold $80 of goods to M. McGuire, but check this out. Since we expect McGuire to take the 12.5% discount, we record the net amount. 80 minus 10 equals $70. That 80 and the 12.5% are right there in the May 4th transaction. Finally, on May 5th, we sold $304 of goods to M. Donald on credit. That 304 is straight from the list. So, we add them all up. 160 plus 70 plus 304. That gives us a total of 534. Does that sum make sense to you? Good catch. Let's break down that $70 figure because it's a classic spot where people get tripped up. Looking at May 4th in your notes, the gross sale is $80 and the discount is 12.5%. First, we find the actual discount amount. 80 times 0.125 gives us $10. Then we subtract that $10 from the original 80. That leaves us with $70 to put in the sales day book. A common mistake is just writing 80 because that's the big number you see first. But since the notes say Marshall expects McGuire to take the discount, we have to use the 70. Does that step by step clear up where the 70 came from? Spot on. But there's one tiny catch. It has to be a credit sale of goods. Basically the stuff the business normally sells. If you see cash mentioned, like the sale on May 3rd for $45, that stays out of the sales day book and goes into the cash book instead. Just to be 100% sure we're on the same page, looking at that May 5th entry for M. Donald, why exactly does that one count for our sales day book total? Exactly. It's a sale and it's on credit, so it's in. Now let's flip the script and look at the purchases day book. Same logic applies, but we're looking for credit purchases of goods. Ready to scan the transactions for credit purchases? All right, first one is May 2nd. We bought goods from A. Clark. The price was $380, but we got a 15% trade discount. Using our equation, 380 minus the $57 discount gives us 323. We always record the net amount after trade discounts. Next up, May 4th. Purchased $400 of goods on credit from D. Daly. That one is straightforward, just the full $400. And finally, May 6th. purchased $100 of goods on credit from G. Perkins, another simple credit purchase. Add those three up, 323, 400, and 100. That gives us a total of 823 for the Purchases Day book. Wait, did you notice I skipped the purchase on May 5th? Any idea why that one didn't make the cut for the Purchases Day book? Nailed it. A check is immediate payment, so it bypasses the day book and heads straight for the cash book. Now let's switch gears to problem 4.3. This one is all about the ledger entries for two specific transactions. First transaction. We bought goods on credit from T-Rater for $450. To get this right, we use the dead click rule. Since a purchase is an expense, we increase it on the debit side. We owe T-Rater money, so our liability, trade payables, also increases. That's a credit. Now for the second one, we returned $700 worth of goods to T-Ruble that we bought on credit last month. Think about this. If we return the goods, do we still owe T-Ruble that $700? Or does our debt go down? Exactly, we don't owe it anymore. Our debt goes down. So, for the returns, we debit trade payables for $700 to show we owe less money. Then we credit purchase returns for $700. When we combine those two transactions together, we get our final table. Does it make sense why trade payables is on both sides here? A credit for the new debt and a debit for the return? You killed it. We covered the day books, handled those tricky discounts, and nailed the ledger entries for returns. I've put together some flashcards for you to review later. Is there anything else from this homework or these concepts? All right, let's pull all those equations and numbers together in one place so you see exactly where everything came from. For the sales day book, we took the 160 and 304 straight from the notes. For McGuire, we used the 80 and the 12.5% discount to get 70. Now for the Purchases Day book, same deal. We pulled 400 and 100 directly. For Clark, we took the 380 and applied that 15% trade discount to arrive at 323. Finally, for the ledger entries in 4.3, the 450 and 700 came straight from the question prompt for Smith Company. We just applied the dead click rules to decide which side they went on. That's the whole breakdown. Does seeing it all mapped out like this help you see where every single dollar came from? In an exam, you have to be like a detective. The hints are hidden in specific keywords. Whenever you see on credit, that's your signal to use a day book. If you see check or cash, it's a trap for day book questions. Ignore them. Also, look for those percentage signs. If there's a percent next to a price, that's a hint that the number in the text is not the number that goes in your table. You've got to do the subtraction first. For those ledger entries, the biggest hint is the direction of the debt. If you are returning something, the debt has to go down, which always means a debit to the person you owe. Does that help you spot them faster?